Welcome to vTalkInsight, Market Drivers Daily for February 18th, 2026. AI is shifting from a one-way boom to a source of sharp drawdowns. Geopolitics are reshaping energy and defense, and market leadership is rotating beneath near-record indices. Let us unpack how these forces around artificial intelligence, geopolitical risk, and cross-asset divergence are interacting in today's markets. AI remains the organizing theme for global markets, but the tone has clearly shifted from uncritical enthusiasm to hard scrutiny. Earlier this week, the focus was on chip bottlenecks and surging orders. Now the center of gravity is whether enormous AI spending can be monetized and which business models sit on the wrong side of that disruption. That change in focus is driving much sharper dispersion between perceived AI beneficiaries and companies that look increasingly exposed to automation risk. Recent price action in individual names shows how unforgiving this environment has become. Netflix is down about 25%, with markets worrying both about new streaming competitors and uncertainty around AI-generated content, which could affect how aggressively it pursues a potential Warner Bros. Combination. In Europe, industrial software names such as Dassault and Siemens have been hit hard as clients experiment with in-house AI tools, challenging the idea that complex design software was insulated from disruption. Broad software indices have softened as investors reassess which products have deep workflow integration and which could be displaced by more automated platforms. Behind the equity moves is an enormous capital expenditure cycle. AI-related spending by large U.S. tech firms is estimated around $300 billion, straining free cash flow and raising questions from shareholders about the timing of returns. That surge is set to increase tech's share of investment-grade credit indices, lifting duration risk and making credit spreads in that segment more sensitive to AI earnings news. Large platforms are leaning on both public bond markets and private credit to fund data centers and chip purchases, creating opportunities for lenders but also concentrating exposure in a small group of issuers. Equity positioning increasingly reflects a deliberate separation between perceived AI winners and those seen as vulnerable. One large bank has built a dedicated AI basket, going long names like CrowdStrike, Palo Alto, Oracle, and Microsoft while shorting software vendors such as Salesforce and DocuSign that are viewed as more exposed to pricing pressure. Crowding into selected beneficiaries is reinforced by deals like the expanded partnership between NVIDIA and Meta on AI infrastructure, which pushed both stocks higher after hours. At the same time, market pricing often still treats areas like cybersecurity as at risk, even though rising AI use is driving security from a mid-single-digit slice of IT budgets toward potentially a quarter over time. The AI race is also becoming more geographically diverse. India is emerging as a key hub, with the Adani Group planning $100 billion of investment in AI-ready data centers by 2035, and global tech giants targeting the country's large, tech-savvy youth base. Chinese AI firms are rapidly increasing valuations and preparing major technology upgrades, signaling more intense competition with Western platforms for global leadership. Venture and growth capital remain eager to fund this theme, with one AI startup reportedly seeking $500 million at a $10 billion valuation, doubled just a month ago, and a large crossover fund raising a $10 billion vehicle focused on AI and adjacent technologies. Macro implications from AI are complex and increasingly central to policy debates. Recent U.S. productivity growth has run near 2.7% annualized over several quarters, with some arguing AI could eventually push that toward 5%, but it is unclear how much of the improvement so far is truly AI-driven. On inflation, AI could be disinflationary if efficiency gains dominate, yet the build-out of data centers and power infrastructure may push up input costs and real interest rates for a period. The Federal Reserve is watching AI's impact on jobs and productivity closely, especially as some estimates link about half of the recent uptick in unemployment to automation, even though adoption rates still look too low for a sudden broad labor shock. Against that backdrop, regulators in the U.S. and Europe are tightening their focus on AI safety, while political calls for limits on data centers and defense uses create additional headline risk for the sector. Putting it together, the AI investment cycle still looks set to accelerate, with infrastructure and well-positioned platforms likely to keep growing. But markets appear more willing to punish missteps and to differentiate sharply between genuine workflow integration and superficial AI branding. Key watch points now are upcoming central bank commentary on AI and labor markets, earnings from major hardware and cloud leaders, and how defense contracts and China's next wave of AI announcements reshape perceptions of long-term winners. Geopolitical risk remains high, with multiple flashpoints in play, even as markets treat the impact as selective rather than systemic. Trilateral talks between the U.S., Ukraine, and Russia are far from a breakthrough, with no progress on territorial questions or proposals such as special economic zones, while Russian strikes on Ukrainian energy infrastructure continue through winter. Sustained U.S. support is still viewed as critical for Ukraine. Yet recent months have seen limited fresh American aid, leaving Europe attempting to fill the gap despite its own fiscal and political constraints. The Iran file is another key driver for energy and regional risk premia. High-level negotiations between Washington and Tehran and Geneva have produced what Iran describes as a general agreement on nuclear principles, and earlier headlines about a broad outline for continued talks helped push Brent crude down more than 2.5%. At the same time, Iranian naval exercises near the Strait of Hormuz and renewed military drills underline how quickly the narrative could flip back toward supply disruption. Analysts note that even in the event of a limited U.S. strike, energy infrastructure is not guaranteed to be a target, which helps explain why recent oil price moves have been relatively muted despite the rhetoric. Beyond immediate conflicts, alliances and defense spending are gradually being reshaped. European defense-related industrial orders, particularly in Germany, have surged as governments respond to the Ukraine war, but production and integration are lagging the political commitments. The European Central Bank is expanding euro liquidity facilities, part of a broader effort to raise the euro's international role at a time when trust in U.S. leadership has been dented by a more isolationist foreign policy stance. In Asia, India is diversifying away from traditional suppliers by planning to acquire over 100 French fighter jets with local manufacturing, while deepening cooperation with France in critical technologies such as AI. AI is increasingly embedded in this geopolitical landscape. The Pentagon is pushing hard into advanced AI for defense, including voice-activated drone swarms, with firms such as SpaceX and XAI shortlisted for a $100 million contract that could change the competitive balance in military technology. At the same time, contract talks with Anthropic are stalled over ethical safeguards and data ownership, and U.S. officials have even labeled the firm a potential supply chain risk, highlighting how values and security concerns are colliding. These tensions may open space for rival platforms, but they also underline that government demand for cutting-edge AI will be balanced against reputational and regulatory risk for suppliers. For markets, the immediate effects of these tensions are most visible in selected assets rather than broad risk-off moves. Oil prices retain a modest geopolitical premium into weekends, yet many cyclical and emerging market assets are still trading mainly on strong global growth data, with safe haven demand channeled instead into gold, government bonds, and notably a stronger Swiss franc. Looking ahead, key signposts will be any concrete text from the Geneva nuclear talks, the evolution of battlefield conditions and energy infrastructure in Ukraine, decisions on U.S. arms sales to Taiwan, and how quickly Europe can translate higher defense budgets into actual capabilities. Together, these factors will shape whether geopolitical risk remains a contained tail hedge in portfolios or starts to challenge the current, broadly growth-friendly macro narrative. Cross-asset divergence remains the dominant market pattern, but the contours are shifting as AI fatigue and geopolitics interact with solid macro data. Despite resilient U.S. growth and improving inflation, major equity indices have been broadly flat year to date, masking sharp sector and regional rotations. The equal weight S&P 500 is approaching all-time highs, even as large-cap benchmarks feel the drag from mega-cap tech and AI names that had previously driven most of the gains. Within equities, leadership has clearly broadened beyond the largest U.S. tech stocks. Investors are rotating out of long-held software and AI names and into both defensives and selected cyclicals, a pattern that has seen utilities and consumer staples hit record highs while the S&P and Nasdaq have struggled. Financials offer another illustration of dispersion. The sector recently suffered its worst week since last April despite strong payroll data, yet more recent sessions have seen periods where financials outperform while large-cap tech lags. Basic resources have underperformed in Europe, with miners such as Antofagasta and Fresnillo falling on weaker guidance and lower silver prices, underscoring how commodity-sensitive sectors are decoupling from the AI narrative. Regionally, the divergence theme now favors non-U.S. markets, consistent with trends seen in recent days. International equities, including Korea, Japan, and parts of Latin America, have outperformed on the back of fiscal support, infrastructure and defense spending, and exposure to the global AI supply chain. Some of that leadership is still tethered to U.S.-centric AI demand, especially in semiconductors, which have outpaced software since last November, but valuations in many overseas markets remain more modest. Looking further out, there is an expectation in some quarters that international equities could outperform the U.S. into 2025 as policy tailwinds and changing sentiment away from highly concentrated U.S. benchmarks play through. Credit markets, by contrast, remain remarkably calm. Spreads are trading at historically tight levels despite rising idiosyncratic risks in equities and ongoing concerns over sovereign debt burdens, signaling either confidence in the cycle or a potential vulnerability if volatility spills over. The AI Capex boom is set to increase tech's weight in investment-grade indices, adding duration and concentration risk, while private credit lenders are becoming more selective towards software exposure. Some managers who kept a conservative, cash flow-focused stance with limited tech exposure have been rewarded as software valuations corrected, highlighting the growing importance of active risk selection in both credit and equity markets. Putting these strands together, recent moves look more like a repricing of AI-related risk and valuations than a clear signal of macro deterioration. Rotations from overvalued tech into cyclicals and real economy sectors align with ongoing fiscal expansion and the prospect of monetary easing, rather than a classic dash for cash. At the same time, safe haven flows into bonds, gold, and defensive equities show that geopolitical and policy uncertainties are far from resolved. Key watch points now are how upcoming AI earnings shape sentiment toward the so-called Magnificent Seven, whether credit spreads finally react to equity turbulence, and if international leadership proves durable once the AI trade normalizes. The balance between momentum and valuation and between U.S. and non-U.S. risk premia will be central to cross-asset allocation decisions over the coming months. Across today's themes, a consistent picture emerges of more discriminating markets. AI remains a powerful secular driver, but heavy Capex, disruption fears, and emerging regulation are forcing clearer distinctions between structural winners and losers. Geopolitical risks from Iran, Ukraine, and Asia are adding selective premia in energy, defense, and safe havens, while most growth-sensitive assets still trade off the macro data rather than worst-case scenarios. And beneath steady headline indices, leadership is rotating away from concentrated U.S. mega-cap tech toward a broader mix of defensives, cyclicals, and international equities, even as credit markets stay unusually calm. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.